Good morning, everyone, and thank you very much for joining. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. Today is Monday, it's the 26th of September. Just going to bring up our high risk investment warning. I'll keep this on screen for a few moments. Hope everyone had a good weekend. And thank you very much for joining so early in the morning. Good morning, Anna. Nice to have you on the webinar. Hope you had a good weekend. Just bring up the market commentaries disclaimer. Just to let you guys know, I'm working on the Q4 report at the moment. So I think it's going to be an interesting read. All right, here's the references. So MarketScope 2.0, TradingView, and Bloomberg. I just put it on the real rate. This is what we've been watching for a fair amount of time now, and I think this is really where the action's actually been, and this is what's rippling through to the markets. We're going to go through the Bloomberg email, 5 things to start your day. And the first headline reads, taking a pounding, which is all about the pound. The pound plunged almost 5% to a record low after Kwasi Kwarteng vowed to press on with more tax cuts, even as markets delivered a damning verdict on the new Chancellor of the Exchequer's fiscal policies. The bulk of the currency slide on Monday took place in a frantic 20-minute sell-off, evoking cries of a flash crash by traders. The beleaguered currency fell to a low of, doesn't look right. We'll take a look at the pound. Anyway, it fell to its lows as investors punished the Chancellor for his unapologetic dash for growth. If the rout continues and widens into broader markets, there's a risk Prime Minister Liz Truss' days-old administration may be pushed into a crisis that could force a rapid policy response. Italy's got a new Prime Minister. Giorgia Meloni won a clear majority in Sunday's Italian election, setting herself up to become the country's first female Prime Minister as the head of the most right-wing government since World War II. Her alliance, which also includes Matteo Salvini's League and Silvio Berlusconi's Forza Italia, claimed about 43% of the vote, according to projections from RAI, the public broadcaster. Meloni emerged from the political fringes after leading the opposition to Mario Draghi's technocratic administration, yet the charismatic 45-year-old has little experience of governing, and she would be taking office at a perilous moment for her country. Next heading, you've been warned. President Joe Biden's administration has privately told the Kremlin that any use of nuclear weapons in the war in Ukraine would have catastrophic consequences for Russia, White House National Security Advisor Jake Sullivan said. Russian President Vladimir Putin renewed his warnings of a nuclear threat last week as he mobilized hundreds of thousands of reservists after Ukrainian forces recaptured a swath of Russian-occupied territory. Those nuclear threats are a matter that we have to take deadly seriously, Sullivan said on CBS's Face the Nation on Sunday. Sullivan said the US also has made it clear in public that it will respond decisively if Russia uses nuclear weapons. The EU's energy plan. The European Union's plan to contain the energy crunch will give member states leeway to cut electricity consumption less than currently proposed, Italian newspaper Corriere della Sera reported, citing a draft document. The European Commission aims to publish on September 28th a document detailing future steps the bloc could take to ease the crisis. Bloomberg reported the proposals under consideration says each state must reduce energy consumption by 5% per hour during peak price hours, representing at least 10% of all hours from December 1st, 2022 through March 31, 2023. All right, let's just go through the last paragraph here. European stocks are on course for another day of declines as fears of faster inflation and global recession continue to pummel the markets. Asian shares slid on Monday as the dollar maintained its rally. ECB President Christine Lagarde is to appear before the Committee of Economic and Monetary Affairs of the European Parliament in Brussels. Expected economic data include German business confidence, Spain's PPI. No major company earnings are scheduled. Hey, Howard. Good. Rob, glad you're back. Okay, nice to have you guys on the webinar. Thanks everyone else for joining. Let's take a look, first things first, at the real rate here. Okay, so this chart has been the chart we've opened the webinars for quite a few weeks, maybe a few months now, and you can see very clearly why this swing has been very much something that we've been watching. And if you take a look at this in terms of a trend, let's take a look at the peaks and troughs. So it can just put in I beg your pardon. This needs to read trough. Okay. And we can put in, let's put in the peak all the way up here. So we kind of been a little loose with this swing here, but we'll put it over here because I believe it's in the spirit of the trend. So we've got a trough peak, and here is our higher trough. And of course, here is the higher peak. And you can just see this is a trend. Now, because we've got this higher peak, it validates this higher trough. And that actually means we can join a trend line. A trend line doesn't define the trend, it just defines the momentum of the trend. So if there is going to be any sort of pullback and this momentum, this current trend's momentum maintains, one would expect the trend line to very much define where the pullback will end. Now, obviously, that's just an inference, so we've got to be very careful about that because it can violate the trend line. But right now, we do have a valid trend line here, and that's measuring the speed of the trend. However, what we need to do here is actually throw in an RSI, because this is where the analysis gets very interesting. And the reason we're throwing in an RSI is because it's a very good indicator for excess. So we throw the RSI in, and you can see we are in excess. Okay, we're in excess here. Let's just change this up. So this makes this is why the analysis is interesting, because fundamentally, I think it does make sense for the real rate to be moving up. We've got a very aggressive Federal Reserve. However, I would suggest that the rate does fall under the general observation that it doesn't move in a straight line, rather it ebbs and flows. It has peaks and troughs. And if that's the case, we've got to be very careful that the real rate here may actually need to pull back just to get the froth out the market, get the really the emotion out of the market. And if there is going to be any sort of pullback here, it's going to disrupt our analysis, because by and large, I'm not sure if the real interest rates have completed. In fact, my feeling is that they are still very much supported. But I think there has to be some sort of pullback just to release, and then we start that next leg. But the problem with a weekly chart, the timing on a weekly chart is poor, because 5 days make a week. So it could take a couple of weeks before we see some sort of normalization here. So we're in a very, the whole year has been a tricky market. Well, this just now is another aspect of the complexities that we need to acknowledge and deal with. Now, let's just see here. Gurdeep saying bonds are becoming more compelling for the big guys. So that's interesting. Let's hold that thought, Gurdeep. We'll come back to it. And Rob just writes here, one thing I'm struggling with is the higher trough in August was lower than the, yes. Yeah. So he's saying, so Rob's saying, but wait a second, is this really a higher trough? Is this a higher trough because it's lower than this trough here? And that's true. That's why I've kind of been quite sort of loose with the labeling. This higher trough is higher than this guy. So what we're doing here, Rob, in terms of the trend line, okay, this higher peak is validating this higher trough here. Okay, this higher peak effectively validates this higher trough here. What are the 2 points that are being connected? Okay, I'm not connecting this point to this point. Okay, I'm connecting this point to this point. So these are the two points sort of in play, but these need to be validated by peaks. Okay, so this peak validates this trough. Okay, and this peak is validating this trough. So this this line over here, I would suspect, again, subject to correction, that it's a fairly good measure of the current momentum. It's not something that would be hard and fast. I think that there's another aspect to trend lines. In sort of strict trend line theory, 2 points actually make what we call a tentative trend line. That's what, to get an actual valid trend line in trend line theory, is actually got to be touched 3 times and validated 3 times. So we're kind of off of that. So there is an element of, I guess, subjectivity put in here, and I would have to admit to that. But I think that we all would agree that we are in a situation of rising real rates. The fact of the matter is, if we have to take a look at this on a monthly basis, it actually blows your mind. Look at this on a monthly basis. Look at this candle. We're on the 26th. This is a crazy candle, isn't it, for a monthly chart? We're also kind of getting to this overbought on the monthly, but so I think to answer your question then, Rob, is number one, I think you're correct. So there is there is an interplay here. I'll tell you why. There's an interplay here that that introduces confusion, and I'll tell you what I think happened here. Okay, I'll tell you what I think happened here. So there's this element of confusion here. So you would be right. Number two, I don't feel that we are far off with this trend line subject to correction, but a third test would be very much welcomed. So let's take a look at that. Now, what I think actually happened over here was a schoolboy error by the Fed. Okay. What was the schoolboy error by the Fed? It was a very weak, press conference by the Fed chair, probably back in, when was it? Well, it was in July, right? Here in July. What did he say? He said we were at neutral. In other words, what happened at this point here is that all the tight sort of monetary conditions that they had successfully implemented, okay, since April, loosened up considerably. It was a schoolboy error. They wanted to tighten the market, and they loosened it in the matter of a press conference. And I think that's what's effectively been reflected here. So again, I'm not of the opinion that the lower trough here is meaningful or concerning, but I think it does give us the option of drawing in this trend line. So I hope that explanation helps somewhat, but I would agree there's an element of subjectivity there. Does that help at all, Rob? What we can take a look at here, by the way, which we always do, is correlation coefficients, because the correlation coefficients, I think, has very much helped in our analysis of the markets. So before we put in correlation coefficient, let's put in the US dollar, and then we'll put in the correlation coefficient with the US dollar. So let's go ahead and do that, because the US dollar has been absolutely rampant. A rampaging runaway train. Okay, so we'll put this in. And you can see that as the real rates moved in that northeasterly direction, no surprise to see that the greenback, the US dollar, did so as well. Now let's put in the correlation coefficient of the real rate to the US dollar, right? So let's put that in. And let me just throw in a label here. Sorry, it's got to be the symbol indicator label. There we go. All right, third tries a charm. All right, so we're on 89%. That's incredibly strong in terms of a correlation coefficient. So there's a certain implication by such a strong correlation coefficient. A correlation coefficient is bounded by 1 and -1, so we're so close to 1 here. This is an incredibly strong correlation coefficient, but there's an implication here. So if the real rate, if the real rate is getting to a point where there should be some sort of normalization, well, one would expect some sort of normalization in the greenback. So if you look at the headlines and the news reports, everyone's talking dollar, dollar, dollar. Well, that's probably a time, I think, when there might be some profit taking here, precisely because the real rate here probably suggests pullback as well. So the idea here don't be surprised to see some greenback weakness starting to creep in. If we start getting some greenback weakness creeping in, well, then that would be very interesting for us, because what we always try and do, okay, is look for those dips, okay, in uptrends. So we're always looking for those dips in uptrends, right? Because that's the those are the best risk-adjusted entries, because you're managing to get something that's trending up at a relatively good price. So if there is some sort of pullback in greenback, and again, I think the cause will be a real rate driven. I suspect. So we've got to see if that's going to manifest, okay? Because this is very much sort of theoretical at the moment, but we are showing signs of heat on that real rate. Then the pullbacks here will be something that we need to pay attention to. All right. So now the obvious question is, well, wait a second. If we are in such a strong, hawkish environment, what would be the catalyst for a pullback in real rates? And that, I think, is a tricky question. I think Gertie actually has sort of hit the nail on the head there, and he's saying bonds are becoming more compelling for the big guys. Well, we've got to pay attention to that. That may be sort of the link. So what we'll do here is we're going to bring in an instrument called IEF. So let's just take a look at IEF, which is an exchange traded fund for bonds. So we're looking at the price of bonds here. All right. Now you can just look how bonds have been completely obliterated. If you're holding bonds, the prices of the bonds have capitulated, essentially. Now, if somebody is holding a bond until maturity, if you're holding a bond to maturity doesn't really make a difference if the price moves, because you're going to get paid your coupon, okay? But if you are active in the bond market, well, it makes a big difference. And so the question is, is the price of bonds becoming compelling? That's the question. So the answer to that is, well, they certainly look like they've been hammered to the point that it would generate interest. And what we're going to do here is throw in our RSI just to see the, no worries, Howard, speak to you. All right, so we'll take a look and we'll see the RSI of this. All right, so that's interesting. I thought it might have been oversold. So we might even see some more pain here, but at some stage, we're going to reach an excess in the bond market where it does become a compelling instrument. And the idea here is, of course, if you are buying bonds and you start pushing the prices up, well, that would generate pullback in interest rates, because there's an inverse relationship between bonds prices and bonds yield. So this might be the factor where there is some sort of market forces which push the yields down. But again, I wouldn't be thinking that the trajectory, that bull market for yields has changed, and why not? So this is where it gets really, really interesting. And after this, we'll start looking at potential instruments that we can maybe trade. But what we can do here is take this out. All right, let's see if we can, I can't remember the exact ticker code. Let's see if I can find it. Fed balance sheet. This is not quite the one. Okay, this one will be fine. All right, so here's the Fed balance sheet. Yeah, this is the Fed balance sheet. All right, so let's throw in a okay, let's throw in a three month simple moving average. So we're looking at the weekly. So we'll just use a 13-week simple moving average here. Let's throw that in. All right, so you can see that the Fed's balance sheet's coming down, and a little bit of a kick up here, but nevertheless we're below the 3-month moving average, and effectively what this is telling us, the Fed is selling off the bonds on its balance sheet. It's exchanging those bonds for money, and then it's depositing those the money into a vault. Okay, so it's taking liquidity out of the economy, and it's really started from about May. Okay, so you've seen the balance sheet, right? Let's take a look at this against the real interest rates. Okay, and let's throw in a correlation here. All right, so this is where we start getting the crossover event. Okay, this is where the Fed starts normalizing its balance sheet. Okay, now there's a lot of interesting things going on in this chart. So we can throw this as put in a 0 here. Okay, so just as the Fed balance sheet peaks, just as it starts selling off its assets, real rates turn positive. No such thing as a coincidence, right? So real rates now turn positive. Okay, what happens to the correlation coefficient? Correlation coefficient is now moving negative. In other words, as the balance sheet is normalized, okay, it's putting pressure on yields to move upwards, and we're getting this negative correlation. Negative correlation's now closer to negative 60%, just under, right? So as long as that normalization continues, one would expect the real rates to be supported. So any sort of movement, Gurdeep, in terms of bond action, I think that would be healthy in terms of releasing some of the pressure on the real rates. But as long as the Fed continues with its normalization policy, which is in the background, regardless of what's happening in terms of any sort of Fed communication, this is happening in the background. There's a stealth tightening behind the scenes, right? So any pullback here must be compelling, but it makes it very complex for us right now. Why does it make it complex for us right now? Because we are at a stage where I think that real rate does need some sort of bond market intervention. That's going to make things complex for us. Okay, so I'm just taking a look at this pound movement. This this movement's absolutely absurd. All right, so you can see that there is a complex sort of environment that we're in. Let's go through to the main layout. Let's take a look at some charts, see if there is opportunities for us. All right, let's just start off with the dollar, and we'll work our way down, and then we'll work around other instruments. All right, so dollar weekly is in uptrend, very strong momentum. I do suspect that we're getting pretty close to the apex of this leg. I think we're getting pretty, and again, just to reiterate, I think that adjustment takes place in the bond market. No surprise to see that we are in the zone 3, but it is starting to roll over here on the daily. So the R1, okay, is quite a distance from the central pivot. I think that if we do fall to the central pivot, I will see if there is any sort of support coming in, but it's a runaway leg at the moment that's rolling over. So I don't think that we have much to talk about until we get to these, either the central pivot or to the S1 level. But if the dollar's coming down, if it's rolling over, then the other majors start looking as if they are bouncing. So you can take a look at euro. Okay, so you can see here euro starting to move up. Now the strength in the euro here, okay, would be strong if we can get to the upper 80 and hold. What's the problem with taking along in the euro? It's counter trend, right? We know that the euro is trending down. Can make this LP, can take out the question mark, right? And we know it's in zone 3, but it just seems that we're overdone in the markets. We're frothy. And we've seen the froth, especially on, I think the whole cause here is the real rates. Those real rates are frothy. Okay, so there is now, I think, quite a strong probability, not absolute, that counter trends may be starting to sort of set up. So be aware of those. Are you going to trade the counters, or are you going to wait for the corrections to effectively end? So you've got to make that choice. Let's take a look at DAX. So if real rates are looking as if they're going to pull back, that should give some sort of support, okay, to stock markets because of the time value of money, right? So we can see we're in downtrend here. Lower peak, lower trough. You can see that we've got a strong momentum down. Okay. But we are frothy. Okay, frothy as can be. So it looks as if there is going to be some sort of corrective period that we're moving into, and we'll monitor it as to see just how strong the correction is. Is there any change up in the fundamentals to suggest, wait a second, this is not a correction? You know, maybe this is, we've hit sort of the bottom, the nadir of the bear market. Now that, of course, we've got to really be cautious about, and just sort of be very careful making that type of a statement. We'll really only know after the fact. But the point is, trading with the trend now, I think it's difficult because of the frothiness that we're in. I think that is the way to start off the week. Monitor it now based on this this release of heat, of froth, of an bought, oversold condition, depending which instrument you're at, depending which instrument you're looking at. And we'll take a look also at how the key levels hold up. Is there any reactions there, or are they getting obliterated? So it's a very interesting start to the week, and I think it's going to be quite a challenging week, and that's how we'll approach it. Any questions? Please go ahead and type those in. We're going to do our second workshop on Thursday. I got some really good feedback. A lot of the feedback suggested actual slides. So besides the Q4 report, I'm going to work on some slides for Thursday just to speed it up. And we'll try to get to actual practical stuff on Thursday as well. All right, any questions? All right, nothing coming through. So I think let us... Thank you very much, Rob. Appreciate that. And I know that I've still got 2 outstanding emails from you. I will get to them this week. Just the first half of the week is going to be quite busy, but hopefully the second half I'll be able to get to them. All right, guys. Let's wrap up. Thanks, Anna. You too. Everyone have a great day, great evening. We'll catch up again tomorrow morning. Thanks, everyone.